Real news for Americans 50 plus. This is Emeritus News Channel.
Mr. Tarullo.
Thank you, Mr. Chairman, Senator Crapo, members of the subcommittee. Let me begin by echoing a few points that my colleagues made in either their written or oral statements. First, compared to the situation of 8 to 12 months ago, the financial system has been significantly stabilized. The largest banking institutions, each of whose financial conditions was evaluated in our stress tests and then announced to markets and the public, have raised $60 billion in capital since last spring. We continue to see a narrowing of spreads in some parts of the market, such as on corporate bonds and in short-term funding markets. Second, however, important segments of our credit system are still not functioning effectively. Many securitization markets have had trouble restarting without government involvement. Lending by commercial banks has declined through much of 2009. This decline reflects both weaker demand and tighter supply conditions, with particularly severe consequences for small and medium-sized businesses, which are much more dependent on public capital on banks than on the public capital markets that can be accessed by larger corporations. Banks will continue to suffer significant losses in coming quarters as residential mortgage markets continue to adjust. Losses on CRE loans, which represent a disproportionate share of the assets of some small and medium-sized banks, are likely to climb. The strains on these banks, when added to the more cautious underwriting typical of recessions, compound the problems of small businesses that rely on community banks for their borrowing. Third, it is important that bank supervisors take an even-handed approach in examining banks during these stressful times. We certainly do not want examiners to exacerbate the problems of declining CRE prices and restricted availability of credit by reflexively criticizing loans solely because, for example, the underlying collateral has declined in value. At the same time, we do not want supervisory forbearance that will put off inevitable losses, which may well increase over time, with attendant implications for the Federal Deposit Insurance Fund. So it's relatively easy to summarize the situation and state the problem. The question on everyone's mind is when and how it can be ameliorated. There are, of course, no easy answers, but let me offer a few observations. We as banking regulators should certainly redouble our efforts to ensure that the even-handed guidance we are issuing in Washington will be implemented faithfully by our examiners throughout the country. But we should not fool ourselves that even the best implementation of this policy will come close to solving the problems caused by significantly reduced demand for commercial properties that were in many cases highly leveraged on the assumption of rising asset prices. The problems lie deeper in a weak economy that has in turn weakened many of our banks. Supervisory guidance is neither appropriate for nor effective as an economic stimulus measure. At the most basic level, the strengthening of CRE markets and a return to a fully healthy banking system depend on growth in the economy as a whole, and particularly on a reduction in unemployment. I believe that the most important Federal Reserve action to promote CRE recovery is through our monetary policy. Our actions to date have helped return the nation to growth sooner than many had expected. Nonetheless, because economic performance remains relatively weak, the Federal Open Market Committee indicated after our last meeting that conditions are likely to warrant exceptionally low levels of the federal funds rate for an extended period. The Federal Reserve has also taken a series of steps to increase liquidity for financing capital to consumers and of interest to consumers and small businesses, including the TALF program, which we recently extended through March with a longer extension for commercial mortgage-backed securities. I suspect, though, that more direct efforts may be needed to make credit available to some credit-worthy smaller businesses. Congress and the administration may wish to consider temporary targeted programs while conditions in the banking industry normalize. Thank you very much, Mr. Chairman.
Thank you. Ms. Metz.